Title: What is NOI? The number behind every commercial real estate deal. If you've ever looked at a commercial real estate deal and felt like you needed a finance degree to follow along, this video is for you. There's one number that shows up in virtually every CRE conversation, every underwriting model, and every broker pitch deck. That number is NOI. Net operating income. Once you understand it, everything else in commercial real estate starts to make sense. Let's get into it. NOI stands for net operating income. It's the money a property actually makes after paying operating expenses, but before paying the mortgage. The formula is simple. NOI equals gross income minus operating expenses. That's it. Let's break down what goes into each side. Gross income is all the money a property brings in. The biggest piece is rent, what tenants pay you each month. But it can also include parking fees, laundry income, storage fees, late charges, or anything else the property generates. Operating expenses are the costs of running the property. We're talking property taxes, insurance, maintenance, property management fees, utilities, landscaping, repairs, anything it costs to keep the building operating. Notice what's not in operating expenses: the mortgage. Debt service, your monthly loan payment, is intentionally left out of NOI. That's by design. Why? Because NOI is meant to measure the property's performance independent of how it's financed. Two investors could own the same building, one with all cash, one with a big loan, and they'd both have the same NOI. The mortgage is a personal decision. NOI is about the asset itself. Let's run through a real example. Say you own a small retail strip center. Your tenants pay a combined $200,000 per year in rent. You also collect $5,000 in parking fees. So your gross income is $205,000. Now let's count the expenses. Property taxes, $30,000. Insurance, $10,000. Property management, $15,000. Maintenance and repairs, $20,000. Landscaping and utilities, $10,000. Total operating expenses, $85,000. $205,000 minus $85,000 equals $120,000 NOI. That's the number. $120,000 is what this property generates before touching the debt. So why does NOI matter so much? 3 reasons. First, it determines value. In commercial real estate, properties are valued based on their income, not what similar buildings sold for, like in residential. Take any NOI and divide it by a market cap rate and you get the property's value. If your NOI is $120,000 and cap rates in that market are 6%, the building is worth $2 million. The NOI is the value. Second, it determines loan eligibility. Before a bank lends you money on a commercial property, they want to know if the property can cover the debt. They take the NOI and divide it by the annual mortgage payment. If NOI is $120,000 and your debt payments are $80,000, that's a 1.5 debt coverage ratio. Banks typically want at least 1.25. Below that, they won't lend. Third, it's how investors compare deals. Just like cap rates let you compare properties at a high level, NOI lets you go one layer deeper. 2 buildings with the same asking price, the one with higher NOI is the better deal, all else being equal. Now here's one mistake people make with NOI. Vacancy. When you're projecting a property's performance, you can't assume 100% occupancy. No property is always fully leased. The standard is to apply a vacancy factor, usually 5 to 10%, to your gross income before calculating NOI. If your building could make $200,000 at full occupancy but you apply a 7% vacancy factor, you're working with $186,000 in effective gross income. That's more realistic, and it's what serious investors use. Here's the one sentence to remember: NOI is what a property earns after operating expenses, before debt. It's the foundation of every commercial real estate valuation, every loan analysis, and every investment decision in the industry. Get comfortable with this number and you'll be ahead of 90% of people in the room. Subscribe and I'll see you in the next one.